Hey guys, my name is Nicolette Mashile. I'm also known as the Financial Bunny. Welcome to the Financial Bunny TV. Today I'm introducing a new feature on the channel. It is called Product Focus. This is where I am going to be telling you information you need to know about certain financial products. So today we're talking all things TFSA. Now, before I get into all of that, do remember that none of my videos constitute as financial advice. If you are looking for financial advice, please do speak to somebody who is certified and registered with the FSCA. So as I mentioned, today we're talking the TFSA. Now it's very, very important for me to mention that there are two different types of tax-free savings account. The other one is also called the TFSA. However, instead of savings account, it's called the tax-free shares account. But I'll get into a little bit of what that means. So maybe let's take it a couple of steps back and answer the question, why was this product even created in the first place? Well, it is because the government saw that South Africans don't have a savings culture, right? Remember July savings month, and we always try to encourage people to save. Well, this is an account that you can save in. However, in the bigger scheme of life, we'll look at the TFSA as an investment product. So I want you to take savings, put that in mind, but also remember the principles of investing. What is the most important ingredient in investing? Time. Time is on your side. You need time to make sure that your investments are going to grow. So let's go back. So the government creates this product and they're like, you know what? We want to encourage South Africans to save. But what is the incentive that we're going to give them? Well, that incentive is tax-free. So in other words, all of the money that you're going to invest in your TFSA, right? And all of the interest that you're going to earn, whether it is interest, whether it is dividends, whether it's capital gains, all of those are going to be tax-free. However, the government does not want the rich to exploit this financial product. So what did they put in place? Restrictions. What are those restrictions? Well, every single year, at the budget speech, we're hoping to hear that they're going to increase the limits. However, as it stands in this financial year, the limits are 36,000 Rand every single year that you can contribute to your TFSA and 500,000 Rand a lifetime limit. In other words, if you do the mathematics, quick calculation, it probably will take you 13 years or so to reach that 500,000 Rand. You are allowed to open a TFSA on behalf of your children. So it's a great and nifty product to also use if you want to save up for your child, because by the time they actually reach their lifetime limit, they probably would want to withdraw that money and it will be a couple of years later, right? So it's a very, very nifty financial product to take in mind. Now, a lot of people are like, what is the point? SARS already gives you an interest incentive. So why would you do this? What is that SARS incentive that SARS gives you? Well, in South Africa, you are allowed to earn interest up to 23,800 if you are an individual below the age of 55. And all of that money is also tax-free. So in reality, let's just be fair. How many people in this country have investments that earn them up to 23,800 or more than that rather? So that's why it's actually very, very important for you to consider having a TFSA. The next question that people ask is, can a TFSA stand in the place of a retirement product? Well, it can be part of your asset allocation, but it cannot replace a retirement fund. Why? Because retirement funds in South Africa are actually regulated under the Pensions Act, which means that you have to follow a certain set of rules for you to be able to invest in those. The one big part of it is that most retirement funds, other than the retirement annuity, allow you to contribute tax-free. So you actually contribute before you pay tax. Whereas if you're going to be contributing to the TFSA, you're probably going to be using money that's already taxed. So that's quite important because in South Africa, there's no such a thing as double taxation, right? So in a retirement fund, it's money before tax. When you get it in retirement, it will then be taxed. In a TFSA, it's money after tax, but when you get it, it is not taxed. So let's quickly go into the two differences between a tax-free savings account and a tax-free shares account. Now, originally, and you will see that most financial institutions, especially the banking sector, have what is called a TFSA, which is a tax-free savings account. This is an account that majority invest in monetary products or money instruments or cash instruments, if you want to call them. This means that they are actually going to be earning interest versus where a tax-free shares account, which a lot of asset management companies have and insurance companies, this is now where you start getting exposure to a different asset class like the equity market, like the real estate market, and the bond market. I've seen in certain instances where fund managers are even adding things like cryptocurrency, they're adding all sorts of different unconventional assets into a TFSA mix to try and make it perform a little bit better. So, who can invest in a TFSA? Anybody. Anybody. If you're looking to start investing in a savings fund, and I know that gets a little confusing, but as I go back, remember, it was created to foster a savings culture. It is indeed, in most instances, traditionally a savings account because it earns you an interest. Think about it as a high interest bearing account. That's literally what it is. However, you need to employ the principles of investing for you to make sure that you will get the best and peak performance out of your TFSA. So what should you not be doing with your TFSA? Because this is what I get all the time. Oh, I'm using my TFSA as an emergency account. Hello? Sorry? How? Because remember, the restrictions on the TFSA is you can only contribute 36,000 Rand every single year. So if you, let's say, for instance, decide in this financial year starting April the 1st to next year, 29th of March, right? If you decide, okay, I'm going to put in my money every single month. Let's say you go 3,000 Rand every single month, right? So you're putting in your 3,000 Rand. Let's say September comes and you have an emergency. And all of a sudden now you need to get access to money. And you decide to go and withdraw the money in your TFSA because you are using the TFSA as an emergency account. You can't replace the money that you've withdrawn. So if, let's say, next year February comes and you get a cash windfall, let's say it's a tax refund, you can't use that money to replace the money you withdrew rather, because you cannot replace funds that you have already withdrawn from your TFSA. You can only contribute up to 36,000 Rand. Anything more than that, you will be taxed at the highest tax marginal rate. And I don't think you want to do that. So it's very important to remember that you can't use the TFSA as an emergency account. Another thing to remember, if you are going to be investing in the tax-free shares account, remember they are buying equity on your behalf. So unlike the savings account where it's much quicker to liquidate your assets, right? Money is quicker to liquidate if you even need to liquidate it from, right? Unless it's invested in foreign currency, they need to convert it back to South African currency to be able to give you a payout. If your money is invested in a tax-free shares account, it means that you are holding certain units of actual equity in companies. So imagine this. You've got your tax-free shares account buying you stock like Vodacom stock, MTN stock, Standard Bank stock, Attack, all sorts of different types of stock. They need to go and sell your stock first. So if you go and you see there that my tax-free shares account, the balance is 30,000 Rand, and you're expecting 30,000 Rand back, you might just be disappointed. Reason for this is, on the day that you give the instruction to sell, the company that is managing or administrating your TFSA, your tax-free shares account, needs to go back into the market, sell your shares, get however much they are getting from that, and that becomes the balance of your actual portfolio. So it's very, very important to remember these things because I don't want you guys to get very, very complicated. Or rather, we don't want to make it complicated. We want to make it as easy as possible. Then people say to me, which is the best TFSA to take out? Now, as you know, I'm not a financial advisor, so I cannot tell you which is the best TFSA to get. But I can tell you this one thing. Look at your needs. Look at where you are invested right now. If there's a little trick that you want to do right now, go sit down. Write down all of the things that you're investing in, whether it's your group schemes, whether it's your policies, whether it's your investment accounts. Write them down. Next to them, write what are they actually invested in. Because a lot of us don't know what our funds are actually invested in. You may find that you've got a fund that is duplicating in another fund. They just call different things. It is important to know what the underlying assets are in your different funds so that you don't find yourself duplicating in terms of the investments that you are making, right? This allows you to put together a very, very nifty asset allocation. What is asset allocation? Well, asset allocation is basically, I have 100 Rand. In my 100 Rand, I'm going to take 20 Rand, I'm going to put it in real estate. I'm going to take another 20 Rand, I'm going to put it in bonds. Another 20 Rand, I'm going to put it in stock. Maybe, you know what, I actually like cash type of instruments because I'm trying to save up. So I'm going to take 40 Rand and then put it into a high interest bearing account. So what you've done is you've given yourself a little bit of diversification in terms of which asset classes you're investing in, but most importantly, you have done the big job of ensuring that you have a diversified portfolio. Someday, I will come back and do a show on how we do an all-weather portfolio. So where you have assets that can speak to each other and that behave a certain way under certain financial circumstances. So you know, for instance, bonds and stock market have different type of volatility. They've got different types of risk appetites because the stock market is far more volatile than the bond market. So your time and how much time you've got to invest, how much money you've got to invest will always tell you which type of asset class you need to be invested in, right? And how much of your money should you be investing in that asset class. So I'm going to leave it here. But before I go, very, very important for me to note once again that none of my videos constitute as financial advice. If you are, however, looking for financial advice, and I think if you are looking and interested in investing in a TFSA, please do go and speak to a certified financial planner who is going to be able to assist you by doing a needs analysis and then giving you a piece of advice, rather, financial advice or a plan that speaks to your needs. I will see you guys on the next Product Focus.